Okay, do you hear me well? Do you see the presentation?
Yes, Professor.
Yeah, great. So, let's start. The next topic will be devoted to the digital banking models and services. And I think this might be a very interesting one because that sits on the intersection of traditional banking and modern technology. And throughout this session, we'll explore how banking has evolved from traditional brick and mortar institutions to today's digital first services. And we will also examine various models that have emerged along the way. So I want to start by acknowledging Brad King's seminal work, Bank 4.0, which is called Banking Everywhere. Never at a bank, which has become a cornerstone um, uh, in understanding the transformation of banking in our digital age. So his insights will help frame our discussion today as we'll explore how technology and changing consumer behaviors have reshaped banking. And what is really interesting about this is uh, that we are all participants of this transformation, whether we are using mobile banking apps or making digital payments or interacting with new fintech services. So by the end of this lecture, you'll have a clear, I hope, you will have a clear understanding on how banking models have evolved and where they are headed. So let me emphasize that this is not just a theoretical knowledge. These are real changes happening in the banking sector that are affecting how we all interact with the financial services. The next slide. So let me tell you why Brad King's work is so significant in understanding the digital transformation of banking. For example, his book Bank 4.0, Banking Anywhere, um, become a fundamental text in our field, and I personally consider it's essential reading for anyone interested in financial technology. And what makes King's analysis particularly valuable is how he captures the profound shift happening in banking, because he's not just describing superficial changes in how banks operate. He's really documenting and complete reimagining of what banks mean in our digital age. And the key insight I want you to take away from the King's work is his understanding that banking is no longer about where you go, but what you do. So this shift from location-based banking to activity-based banking is really revolutionary. If you think about it, when, for example, was the last time you actually needed to visit a physical bank branch? King's analysis helps us understand not just where banking has been, but more importantly, where it's going. So he shows up how technological advancement and change in consumer behavior are creating new possibilities that would have been unimaginable just a decade ago. And as we move through today's lecture, you'll see how his framework helps us make sense of, I would say, of the rapid changes happening in banking, even from the rise of digital-only banks to the integration of artificial intelligence in financial services. The next slide. Now, let me introduce you to a framework that helps us understand how banking has evolved over time. So this model breaks down banking evolution to distinct stages, and I find it really particularly useful because it shows us not just where we are, but how we got here. And the model identifies several key drivers of banking evolution that I want us to examine closely. First, there is technological advancement, and this has been the primary catalyst for change in banking. Because if you think about how computing power, internet connectivity, and mobile devices have fundamentally altered how we interact with our money. And then we have customer needs. And this is crucial because it's not just about what technology can do, but what customers want it to do. So I've observed really how customer expectations have shifted dramatically over the years, particularly in terms of convenience and accessibility. And the regulatory landscape has also played a vital role. For example, in my experience working with the banks, I've seen really how regulators both constrained and enabled innovations. So they're not just they were not just obstacles to overcome, but actually shape how banks evolve their business models. And speaking of business models, so these have had to adapt continuously to remain competitive. So it's fascinating, really, to see how banks have transformed from simple deposit-taking institutions just to complex financial service providers. And I think that this framework gives us a structured way to understand these changes, and we will explore each stage in detail to see how these factors have shaped modern bank. The next. Now let's start with the Bank One concept. It represents actually traditional banking in its purest form. And I want you to imagine banking as it existed for hundreds of years, where a world where every single financial transaction required a physical visit to a bank branch. So you can think about this for a moment. If you needed, for example, to withdraw money, deposit a check or transfer funds, or even just check a balance, so you had to physically go to the bank during business hours and interact with the teller. And this was banking in the most basic physical form. What's interesting here about the Bank One concept is how it shaped people's relationship with money and financial services. So the bank branch wasn't just a service point, it was a symbol of financial stability and trust. And those impressive I would say, those impressive bank buildings with their marble columns weren't just for show. They were designed to convey permanence and security of the banking. And in my view, understanding Bank 1.0 concept is crucial because it helps us appreciate just how dramatically banking has changed. When we talk about digital transformation, this is our starting point. This is a world where banking was entirely location dependent and human mediated. And the limitations of this model are obvious to us now because it is restricted operating hours, geographical constraints, slow processing times, for example. But at the same time, this was simply how banking worked. And these limitations would eventually drive the transition to Bank 2.0, which we'll discuss next. The next slide. So now let's explore Bank 2.0 concept, which marks a crucial turning point in banking history. This era actually represents what I consider the first real technological revolution in banking. And here was the introduction of computerization and automation. And one of the most visible symbols of the Bank 2 was the ATM, automated transaction machine, which fundamentally changed how people accessed their money. So, and here I wanted to appreciate just how revolutionary this was for the first time. And just imagine that customers could perform basic transactions without interacting with the human teller. This was really the first step towards self-service banking. But the changes weren't just customer-facing, because behind the scenes, banks were undergoing a massive transformations as they computerized their operations. For example, paper ledgers were replaced by electronic databases. Manual calculations gave way to automated process, and this might seem basic by today's standards, but it was really revolutionary at the time. And what is particularly fascinating about Bank 2 concept is that it represented a hybrid model. What that meant, branches were still important, but technology began to complement and enhance traditional banking services. And here, banks started to realize that efficiency didn't just mean faster service, it meant giving customers more control over their banking experience. And really, this era laid the groundwork for the future banking innovations by, I would say, demonstrating that customers would embrace technological solutions. And if they, for example, made banking more convenient and accessible. So now we have come up to the break. So let's break for 10 minutes, if you don't mind. Is that okay with the break?
Okay, so 10 minutes break, Professor?
Yes, yeah, sure.
Okay.
Thank you. Okay, now let's get back. Please tell me, do you see the presentation? Do you hear me well?
Yes,
Are there
Professor.
any noises? Okay.
No noises. Everything is good.
Yeah, great. So let's go on. So here, the Bank 3.0 concept of the banking development represents what I consider one of the most transformative shifts in the banking industry and in the banking history as well, which is the advent of internet banking. And this was the moment when banking truly began to break free from physical constraints. And let me paint a picture of just how revolutionary this was. Suddenly, for example, customers could access their accounts and perform transactions from their home computers. No more rushing to the bank before closing time, no more standing in queries, and banking really became available 24/7. And this fundamentally changed people's expectations about financial services. And what I find fascinating here about this era is how it democratized, I would say, banking access. For sure, with a computer and internet connection, customers in remote areas could now accept the same banking services as those, for example, of you living next door to the branch. So we can think about the implications of this, like geography was no longer a barrier to banking services. And the range of services available online grew rapidly, from simple balance checks to complex transactions, fund transfers, and even bill payments. All could be done through bank websites. And this wasn't about convenience, it was about giving customers more control over their financial lives. But perhaps most importantly, Bank 3 concept marked the beginning of what we now call digital banking. So it showed us that banking doesn't need to be tied to physical locations, and an insight that would become even more important in the mobile era that followed. The next slide. Now we arrive to Bank 4.0 concept, so which I believe represents the most profound transformation in banking to date. And this is where we currently are, and it's revolutionizing not just how we bank, but how we think about the financial services altogether. And the catalyst for this transformation was the smartphone. You can consider this. Most of us now carry in our pockets a device more powerful than the computers that once ran entire banks. So mobile banking apps have become the primary touch point between banks and their customers. And I've seen statistics showing the same people check their banking apps almost daily. But Bank 4 isn't just about mobile apps, it's about the integration of cutting-edge technologies. So we are seeing artificial intelligence making personalized financial recommendations, blockchain technology revolutionizing payment systems, and machine learning detecting fraud in real time. And these aren't just add-ons to traditional banking. They are fundamentally reshaping what banking means. And what excites me most about the Bank 4 is how it's breaking down the traditional boundaries of banking. So banking is becoming embedded in our daily lives in ways we could have imagined even a decade ago. So you can now make payments, for example, through social media apps, get instant lending decisions, or trade stocks while waiting for a coffee. And the key principle of Bank 4 here is what banking is that banking should be invisible, embedded, and real time, available whenever and whatever customers need financial services. The next slide. Looking ahead to Bank 5 and beyond, we are entering what I believe will be the most exciting era in the banking history. And the future of banking is shaping up to be more personalized, more integrated, and more intelligent than anything we've seen before. So let me share my vision of what's coming. Let us imagine banking services that don't only respond to our needs, but anticipate them. Simply think artificial intelligence systems that can predict your financial needs before you are even aware of them. For example, offering personalized solutions in real time. And this isn't science fiction. The technology is already being developed. And the concept of banking everywhere, but not necessarily at a bank, will reach new heights, because we are moving towards what I call ambient banking, where financial services are so seamlessly integrated into your daily lives that we barely notice them. So your refrigerator, for example, might automatically order groceries. Your car could pay for its own fuel, all while optimizing your spending and saving Spartans. And big data analytics and machine learning will enable hyper-personalization of banking services. And for example, instead of offering standard products, banks will create customized solutions based on individual customer behavior patterns and preferences and needs. But what is interesting about that is how these technologies will democratize financial services, making, for example, sophisticated banking capabilities accessible to everyone, regardless of their location or economic status. This is the true promise of Bank 5.0. Not just better banking, but more exclusive banking. And the next slide. Now let's consider and dive into something really interesting, which is the IBM metrics for neobank classification. So in my research and experience with digital banking, I found this framework particularly valuable for understanding how different neobanks position themselves in the market. So IBM's research has identified 4 distinct business models that neobanks typically follow. What I find interesting here about this classification, is how it helps us understand not just what neobanks do, but why they make certain strategic choices. And before we dive into each model individually, I wanted to understand why this classification matters. So in the rapidly evolving fintech landscape, I think understanding these different approaches helps us predict which neobanks are likely to succeed and why. And it's not just about having the latest technology. It's about having the right business model for your specific market situation and target audience. And each of these models represents a different approach to solving the same problem, how to deliver modern banking services in a digital age. So what's particularly interesting is that no single model has emerged as definitely superior, because success depends here on how well the chosen model aligns with the bank's resources and with the also target market and strategic objectives as well. So let's examine each of this model in detail to understand their unique characteristics and advantages. So let me introduce you to Model A neobanks, which I find particularly clever in their approach to digital banking. And these are what I call wolves in sheep's clothing. So they appear to be fresh, innovative startups, but they are actually backed by the traditional banking powerhouses. So take, for example, Frank or LKXA as examples. So these neobanks are fascinating because they represent traditional banks' answer to a crucial challenge: how to appeal to digitally native customers without risking their existing brand. And what is smart about this approach is that these banks get to have their cake and eat it too. So they represent a fresh, innovative face to the market while leveraging their parents' bank robust infrastructure. So I have observed that this model works particularly well because it combines the best of the both worlds. From the customer's perspective, they are getting a modern digital-first banking experience, but behind the scenes, these neobanks benefit from their parents' banks' established systems, regulatory compliance frameworks, and also financial resources. And what is interesting as well is the psychology behind this approach, because traditional banks recognized that some customers, particularly younger ones, for example, might be turned off by the traditional banking brands. And by creating these seemingly independent digital banks, so they can capture this market segment without cannibalizing their existing customer base. The next slide. So now let's look at the Model B neobanks, which I find interesting because they've taken a laser-focused approach to innovation. Because rather than trying to reinvent the entire banking infrastructure, these neobanks like Simple, Movin in the USA, they have made a strategic decision to focus on what matters most to modern consumers, that is the user interface. And what I find brilliant about this approach is its pragmatism, actually, because instead of spending years and millions building banking infrastructure from scratch, these neobanks partner with existing banks and pour their energy into creating exceptional digital interfaces. And it's like putting a Tesla, for example, dashboard on a proven engine, and you get the best of both worlds. So let me explain why this model is so effective. Because by leveraging existing banking infrastructure through partnerships, so I think these neobanks can launch much faster and with significantly lower capital requirements, for example. But here's the clever part, because they maintain complete control over the customer experience, which is increasingly the key battlefield in the digital banking. And in my analysis of successful Model B neobanks, I have really noticed they excel at solving specific pain points in traditional banking, because they might offer better budgeting tools, more intuitive payment systems, or clearer financial insights. And because they are not locked down by legacy systems, because of that, they can iterate and improve their user experience rapidly based on customer feedback. And this model demonstrates actually that in today's banking world, owning the customer relationship through a superior user experience can be more valuable than even owning the underlying banking infrastructure. The next slide. So now let's examine Model C neobanks, which represent what I consider a particularly sophisticated approach to digital banking transformation. So a prime example here is Hello Bank by BNP Paribas. And their strategy, for example, reveals some fascinating insights about modernizing banking infrastructure. So what really stands out about the Model C is that it's recognition of the fundamental truth, because the legacy banking systems are often too rigid to support rapid digital innovation. And we have to think of it's like trying to run modern software on a computer from 1990s, for example. That is technically possible, but far from optimal. And that's why these banks create separate subsidiaries with the modern flexible systems. So I have observed actually that this approach solves a critical challenge in banking transformation, because of instead of trying to retrofit old systems, which is like renovating a house while living in it, these banks built a new modular infrastructure from the ground up. And on the other hand, this allows them to be much more responsive to changing customer needs and to technological opportunities. And what's clever about this model is how really it maintains the benefits of being part of the larger banking group while avoiding its technological constraints. And the parent bank here provides the regulatory framework and financial backing, but the subsidiary has the freedom to build modern, flexible systems that can deliver a true omni-channel experience. And this is really crucial because modern banking isn't just about having good mobile apps. So it's about creating seamless experiences across all channels, whether digital or physical. Next slide. And now let me explain Model D neobanks, which represent perhaps the most digitally native approach among all the models we've discussed before. The key examples here are banks like Feeder Bank or Tangerine. So what makes these neobanks unique is their fundamental DNA. That means they are conceived and built as purely digital entities from the day one. Unlike other models that might have evolved from traditional banking or partnered with existing banks, these institutions position themselves as fully digital banks from the very beginning. And the entire value proposition here revolves around digital technologies. So while they might maintain some physical touch points or, for example, call centers for customer support, nevertheless, they are secondary to their core banking offering, or core digital offering. And the real value they provide comes through their innovative digital services. So we have to think about this way. While other banks might use digital channels as one of the many ways to serve customers, for Model D neobanks, the digital isn't just a channel, it's their primary reason for being. Because their systems, their processes, and their customer interactions are all designed with a digital-first mindset. And this approach allows them to be more agile and more innovative in their service delivery, often leading the way in adopting new technologies and setting trends in digital banking services. And they can quickly roll out new features and adapt to changing customer needs because they are not constrained by legacy systems or traditional banking mindsets. And the next slide. And now I'd like to introduce you to an increasingly important concept in modern banking, the ecosystem banking model. So this represents a significant shift from traditional banking approaches, and I believe really that its transformation and it is transforming how banks create value for their customers. So let me explain what makes this model unique. It's unique because instead of just offering standard banking services, ecosystem banks aim to address a much broader spectrum of customer needs. So they bundle traditional financial services with the non-financial offerings across various aspects of customers' lives, from lifestyle services to healthcare and to entertainment. And I'll give you a concrete example. Look at what, for example, Sberbank has done. So they have created an ecosystem where customers can not only manage their money, but also order groceries, consult with the doctors through telemedicine services, and even book a taxi, all through a single integrated platform. And this strategic thinking behind this model is quite compelling, because by offering this bundle of services, banks can achieve several key objectives. So they significantly increase customer loyalty because people are more deeply integrated into their service ecosystem. And they can generate higher average revenue per user by monetizing multiple services. And perhaps most importantly, this model helps them better compete with emerging fintech companies that might otherwise chip away at their core business. And what's particularly interesting about this model is how it transforms the traditional banking relationship from occasional transactional interactions into a daily presence in customers' lives. Because this represents a fundamental shift in how banks position themselves in the modern digital economy. So, the next slide. Now, let me share with you how major banks are aggressively pursuing ecosystem expansion strategies. So, what we're seeing is a fascinating trend where large financial institutions are moving far beyond their traditional banking boundaries. So, and the approach these banks are taking is quite comprehensive. So, because they are using three main strategies to build their ecosystems. Which are direct acquisitions of companies, forming strategic joint ventures, and finally making targeted investments in promising sectors. So, let me give you a striking example of this strategy in action. For example, Sberbank, which I mentioned earlier, made a remarkable 37 acquisitions in just 2 years. These weren't random purchases. They were strategically chosen to build capabilities in key areas like cloud computing, logistics, fintech, and media services. But on the other hand, Sberbank isn't alone in this approach. So we are seeing similar moves from other major players. For example, take Ping An, for instance. They've been particularly focused on acquiring health technology startups to build out their healthcare ecosystem. Or look at Alipay, which has expanded into seemingly unrelated areas like food delivery and bike sharing services. And what's particularly interesting about this trend is the speed and scale at which these banks are moving, because they are not just dipping their rolls or their toes in the water. They are making bold, decisive moves to secure their position in the digital economy. And this rapid expansion reflects their understanding that in today's market, standing still is effectively moving backward. The next one. So now let me tell you about one of the most effective strategies that ecosystem leaders are using to maximize customer value. So I'm talking about premium subscription programs, and the results we are seeing are quite remarkable. So let's look at some of the major players who are doing this successfully. For example, companies like Amazon, Alibaba, and Yandex have implemented subscription programs that offer an impressive array of benefits. And this is typically includes special discounts, cashback offers, and early access to the new services or features. So, and it is interesting that the data on how this programs performs is very crucial, because our analysis shows that these subscription models deliver exceptional value relative to their cost. Because, for example, let me give you a specific example that really drives this point home. For example, Amazon Prime members, and this is quite remarkable. It shows for about 6.6 times higher return on investment for their subscription. But here's what's even more interesting. these same customers tend to increase their overall spending by 4.6 times. So, and we have to think about this, what this means from a business perspective. So these aren't just revenue streams, they are powerful tools for deepening customer relationships and for driving long-term engagement of the customers, because the subscription model creates a virtuous cycle. That means that customers get more value, which leads to more usage, which in turn creates more value for both customer and the platform. So now let me explain why the technical infrastructure behind ecosystem integration is so crucial for customer retention. At the heart of these are two key technologies: single sign-on, or SSO, and integrated customer data platforms. So this makes these technologies so powerful, and this is about the ability to create a seamless user experience. So we can imagine logging in just once and having access to every service within the ecosystem. That's exactly what companies like Google and Amazon have achieved. So they maintain unified customer profiles across the entire range of services. So, and now let me share why this is so strategically important. Because when customers are deeply integrated into the ecosystem through shared logins and data, the cost of switching to competitors becomes significantly higher. And you have to think about it. If you are using multiple services from one ecosystem with all your preferences and history in one place, you are less likely to switch to a competitor who only offers a single service, for example. And I find it particularly interesting how this technical integration creates what we call sticky customer relationships. So this is not just about convenience, it's about creating an environment where the whole ecosystem becomes more valuable than the sum of its individual services. When customers are these deeply integrated, they really typically show much lower churn rates compared to users of standalone applications. Now let's talk about why fintech capabilities are becoming absolutely essential for any bank looking to compete in the ecosystem space. So now we are seeing a clear pattern emerge in what successful ecosystems platforms need to do. Looking at the requirements, there are two critical aspects that banks need to focus on. First one is they must expand their core fintech capabilities. And this isn't optimal anymore, it's fundamental. And we are talking about robust payment systems, innovative lending solutions, and sophisticated investment platforms as well, because these aren't just nice to have features. So they're the foundation of modern banking services. And let me give you some concrete examples of how leading companies are implementing this. For example, if we take Ping An, so company, they have built a comprehensive suite of financial services that goes well beyond traditional banking. And also they offer everything from wealth management to lending and even crowdfunding services, all alongside their core insurance business. Or, for example, if you look at the Razorpay, so they have made an interesting strategic move by launching neobanking services to complement their payment process and platform. And this is a really perfect example of how companies are expanding their fintech capabilities to drive both engagement and monetization. And the key takeaway here is that basic fintech functionality is no longer a differentiator because it's a prerequisite for competing in the ecosystem banking space. And banks that don't develop these capabilities, they risk being left behind as the industry continues to evolve. Just a second. So let's go on. The next slide. Now let me share with you some exciting developments in how bank-led ecosystems are expanding into new territories, particularly in education and wellness services. In other words, this trend is becoming increasingly significant in digital adoption, which continues to accelerate. And what we are seeing is fascinating here, that major players are making strategic moves into these sectors. For instance, Alibaba has formed partnerships with universities to expand their educational offerings. Meanwhile, tech giants like Google and Apple are enhancing their health tracking capabilities. And these aren't random expansions because they are carefully calculated moves into high growth sectors. And what is interesting here is how these markets align perfectly with the preferences of, for example, millennial customers. So now let me explain why this is significant. Because millennials are increasingly looking for integrated services that add value to their daily lives. And for example, by offering education and wellness services, banks here can attract and retain these younger users who might otherwise, for example, be less engaged with the traditional banking services. And the beauty of this approach is that it creates actually multiple touch points with the customers throughout their daily routines. So if you think about it, when a bank can help you manage both your finances and your health or educational goals, so it becomes a much more integral part of your life. And this isn't just about offering more services, it's about creating deeper, more meaningful relationships with customers. Now the next slide. Now let me explain why partnerships are becoming critical for banks' buildings in terms of building their ecosystems. So this strategy is particularly fascinating because it solves several challenges simultaneously. Let's be honest, banks typically don't have the in-house expertise to deliver, for example, high-quality non-financial services. And this is where strategic partnerships become invaluable. For example, by partnering with the specialized providers, banks can leverage external innovation without even having to build everything from the scratch. And what is particularly clever about the approach is how it allows banks to focus on what they do best. For example, you can think about what banks already have. So they have customer trust and extensive reach. And this is incredibly valuable assets because that can be combined with the partner's specialized capabilities. So now let me give you some real-world examples, for example, of how it might work. If you look at this Sberbank, so they have partnered with Ozon for delivery services, or consider Yandex, which powers ride-hailing services for banking partners. And these partnerships create win-win situations where each party brings their core strengths to the table. And there is another crucial advantage to this partnership approach because it significantly reduces the risks associated with entering new verticals. Because instead of making large investments in unfamiliar areas, banks can test and scale services through partnerships, making the expansion to new sectors much more, I would say, manageable and less risky. So now let me introduce you to another important framework for understanding the neobank landscape. And this model identifies 4 distinct archetypes, and I find it really particularly useful for understanding how different neobanks position themselves in the market. So first, we have traditional neobanks. So these are the ones that focus on providing basic banking services through mobile apps. And then we have the market leaders who are particularly interesting because they achieve rapid scale through innovative offerings. And the challengers take a different approach because they compete by targeting specific niches with differentiated services. And finally, we have the followers who essentially copy elements from successful neobank models. So what makes this framework particularly valuable is how it helps us understand the distinct strategies and offerings of each type. So, and now to support this, let me emphasize that each archetype targets, for example, different demographics, and each archetype follows different business approaches here. So, and I can find it very interesting how these different models have evolved to serve, for example, various market segments. Because when we analyze the neobank landscape through this lens, so it becomes much clearer why some succeed, some of them succeed, for example, while others may struggle. And in other words, understanding these archetypes is absolutely crucial for anyone looking to access or to participate in the neobank space, whether as a competitor or an investor or a partner. Next slide. Now, let us delve into the challenges faced by traditional neobanks, as this reveals some crucial insights about the digital banking landscape. For example, these traditional neobanks typically start with the straightforward value proposition. So they offer basic banking services like accounts, payments, deposits, lending, all accessible through mobile apps, and usually their main selling point is the ease of use through these mobile applications. And however, here's where it gets interesting and concerning as well. So the data from, for example, Exton Consulting reveals a starting statistic. For example, 64% of traditional neobanks fail within the first 5 years. And that is fascinating. And let me explain why this may happen. The matter is that there are 3 main challenges these banks face. First, they struggle with low revenue from basic services, and it's hard to make money when you're only offering standard banking products. Second, they face extremely high customer acquisition costs in in an increasingly competitive market. And third, perhaps most critically, they often lack meaningful differentiation from their competitors. And this is really highlights a fundamental challenge in the neobank space, because while it's relatively straightforward to launch a basic digital banking service, building a sustainable business model is much more complex. And the lesson here is that simply being digital isn't enough, because neobanks need to find ways to create unique value propositions and to generate sustainable revenue streams. So the next slide. Now let's talk about what makes market leading neobanks like Revolut, for example, particularly successful. And their approach offers fascinating insights into how digital banks can achieve rapid growth and maintain market leadership. And what sets these leaders apart of their relentless focus on innovation. So that is a matter. Now let me illustrate this with the Revolut strategy. For example, they have built their success on continuously introducing innovative features that go well beyond traditional banking. And they have integrated cryptocurrency trading, added stock trading capabilities, launched business accounts, and implemented even smart subscription pricing models. And what is interesting here about their approach is how each new feature creates multiple benefits. Not only does it attract new customers, but it also opens up additional revenue streams, because this creates a powerful growth engine, which is innovative features drive viral growth, and which in turn provides resources for developing even more innovations. And the genius of this model, actually, as to my opinion, lies in its self-reinforcing nature, because each successful innovation strengthens their market position and provides them with valuable data and insights for the future developments. This is why market leaders like Revolut, for example, can maintain their growth momentum even in an increasingly competitive market. The next slide. Now let us consider how challenger neobanks are carving out their own space in the market through highly focused strategies. And this approach is particularly interesting because it shows how smaller players can effectively compete with the larger banks. So now let me share some compelling examples of how different challengers have found their unique niches. For example, if we take Starling Bank, they have built an impressive position by focusing specifically on small businesses. So they now serve for about 2 million business accounts, offering superior analytics and transparency that this segment particularly values. And then we have Monzo, for example, which has taken a completely different approach, because they have built their entire brand around appealing to younger customers with the specialized budgeting tools and social features that resonate with this demographic. And look at the N26 strategy, for example. They have developed what I find to be a clever tiered approach, because they offer basic services for free just to attract customers. Then they gradually upsell them to premium subscriptions with the additional features. And what makes these challenger strategies so effective is that their laser focus on specific market segments or specific needs. Because instead of trying to be everything to everyone, like the market leaders, they just excel in serving particular niches extremely well. And this focused approach allows them to build strong relationships with their target customers and compete effectively despite their smaller size. The next slide. Now, let me explain how a follower neobanks operate in today's digital banking landscape. And these are interesting cases because they essentially try to replicate successful elements from other neobank models. So it is really noteworthy that these follow neobanks look at what works across traditional market-leading and challenger neobanks and then attempt to piece together their own formula for success. However, these results are quite mixed in practice. Now, let me give you two contrasting examples that illustrate this point. For example, in Germany, Comdirect company achieved considerable success by adopting digital account features from the other neobanks. And in particular, they managed to understand their local market needs while implementing proven digital solutions. And on the other hand, when Telstra, for example, tried this approach in Australia, they struggled to gain any meaningful traction despite carefully copying features from the market leaders. And this really highlights an important lesson. Simply copying features isn't enough, really. And the key to success here for the follow neobanks lies in their ability to carefully select which elements to replicate while ensuring they align with their specific market context and with their customers' needs. And those that manage this careful balance can for sure establish strong regional positions. But without this thoughtful adaptation, where mere imitation rarely leads to success in the competitive neobank space, I would say. Next slide. So now let's shift our focus to another fascinating way of categorizing digital banking models, which is one of that based on the primary strategic focus or preference. What I find here particularly interesting about this classification really is how it reflects different approaches to meeting customer needs in the digital age, for example. Because each model we are going to discuss, whether it's client first or mobile first or AI first, so each model represents a distinct philosophy about how banks should prioritize their service delivery and customer engagement. And in general, these models aren't mutually exclusive. So in fact, many successful banks combine elements from each. But however, understanding the core focus of each model helps us better comprehend how different banks position themselves in the market and what they consider their primary value proposition. And in the following slides, we will delve deeper into each of these models, examining their unique characteristics and how they are shaping the future of banking, for example. And that is especially important to note that is how each model approaches the change, challenge, and of enhancing customer experiences in its own unique way. So let's explore each of these models in detail to understand their distinct features and the specific advantages they offer to both banks and to their customers. The next. So now let me tell you about the client-first banking model, which I find particularly really fascinating because it represents a fundamental shift in how banks approach their business. So the core principle here is quite straightforward but powerful. So that is everything starts with understanding what clients actually need and what they want from their banking experience. So what's remarkable is that this isn't just about offering banking products, but it's about designing comprehensive financial solutions, but that truly address customer pain points and aspirations. So, and now let me share some compelling data with you. For example, a few researches show that for about 73% of customers consider their experience as a crucial factor in choosing their bank. And this statistic really underscores why this model is gaining such traction in the industry. So I'd also like to highlight an excellent example of this approach. For example, Umpqua Bank, they have completely reimagined that what a banking experience should feel like. So, for example, they have created what I would call a banking cafe, which is an environment where you can discuss your finances over coffee, for example, and they have extended their service hours to accommodate different customer schedules. And it's a perfect illustration of putting customers' preferences at the corner of the banking model. And what makes this model particularly effective is its focus on building long-term relationships rather than just processing transactions. And it's about creating an environment where financial services feel more accessible and less intimidating to customers. The next slide. Now let's talk about insights about the model, mobile first banking model. Which has fundamentally transformed how people interact with their financial services. So what is striking here is the adoption rate, because statistics shows that over 58% of the American adults now primarily use mobile devices for their banking needs. This isn't just a trend, it becomes the new normal in banking behavior. So now let me highlight some of the leading players in this space. Banks like Chime, Varo, and Current, for example. So these banks all are special in their complete embrace of mobile technology because they have designed their entire service ecosystem around the mobile experience. From account opening to daily transactions and payments. And what is interesting here is about this mobile first banks is how they have reimagined traditional banking features for the digital age, because they offer innovative services like instant budgeting tools, early access to paychecks, and they have even eliminated overdraft fees, like features that particularly resonate with digital native users. And the key advantage here is that anytime, anywhere accessibility of these banks, because you can think about it, you can now manage your entire financial life from your smartphone, whether you are communicating to work, traveling abroad, or sitting at home. This level of convenience and accessibility was unimaginable just a decade ago. The next slide. Now, let me walk you through how artificial intelligence and how data analytics are revolutionizing the banking sector, particularly in terms of personalization. So first, let me explain the core capabilities that banks are developing with AI and machine learning. So these technologies are doing something remarkable because they are analyzing vast amounts of customer data to understand behavioral patterns and to create truly personalized product recommendations. And it's not just a basic segmentation for sure. It's sophisticated analysis that can predict customer needs before they even arise. And what is exciting is the evolution of AI, artificial intelligence, virtual assistants in banking, especially, because they are not just simple chatbots anymore. So because they're becoming sophisticated financial advisors that can help optimize your spending patterns, for example, provide contextual financial advice, even detect potential fraud in real time. And the level of sophistication here is quite remarkable. And the benefits of implementing AI in banking extend far beyond just operational efficiency, because what we are seeing is a fundamental shift in how banks can deliver personalized services. Because AI enables banks to handle client requests more efficiently while simultaneously providing more relevant and personalized offerings. It's like having a personal banker who knows your financial habits intimately and is available 24/7. And this combination of AI and data analytics is really setting a new standard for what customers can expect from their banking experience. Okay, the next slide. Now, let me introduce you to the one of the most transformative developments in modern banking, which is a banking as a service model, or BaaS. This is fundamentally changing who can offer banking services and how they are delivered. So what makes BaaS particularly interesting is how it's essentially democratizing financial services, because traditional banks are now providing their infrastructure and licenses to non-banking institutions, creating, for example, entirely new possibilities in the financial sector. And now let me share some concrete examples. For example, you can think about the companies like Apple, Google, or even Amazon, because these tech giants aren't traditional banks, but through BaaS partnerships, they're now able to offer sophisticated financial products to their massive user bases. And this is completely reshaping the competitive landscape in financial services. So what is particularly striking in the growth we're seeing in this space is that our latest data shows that over 50% of BaaS partnerships experienced growth in 2023 alone. And this remarkable growth really underscores the rising importance of embedded finance in our digital economy. And the beauty of this model lies in the ability to foster collaboration between traditional banks and non-bank players, because it's not about competition anymore. It's about leveraging each other's strength to create better financial services to customers. Okay, the next slide. Now, let me walk you through the key components that make up the banking as a service ecosystem. So this is a complex but fascinating structure that enables non-banking entities to offer financial services. And when we look at BaaS architecture, for example, we are essentially dealing with the several interconnected layers. At the foundation, we have traditional banks providing the core banking infrastructure and regulatory compliance. And these banks hold the necessary licenses and maintain the fundamental banking operations. But above this, we have the BaaS providers who create the crucial middleware. which are the APIs, automated programming interfaces, and integration layers that make banking services accessible to third parties. This is where the magic happens, really, especially in terms of making banking services modular and easily integratable. And at the top layer, we have the fintech companies and non-banking businesses who utilize this infrastructure to offer financial services to their customers. If you think about the companies like for example, like digital wallets, e-commerce platforms, or even retail chains, so all of them want to offer their financial services to the customers. And this kind of model can be particularly powerful because it enables rapid innovation while maintaining regulatory compliance and security. And it's essentially creating a new paradigm in how financial services can be delivered to customers. So now let me explain the transformative concept of open banking in general and why it's becoming increasingly crucial in our digital financial ecosystem. At its core, open banking represents a fundamental shift in how financial data is shared and utilized. Because through secure APIs, banks can now safely share customer financial information with the authorized third parties. And what makes this particularly powerful is how it enables the creation of more personalized and innovative financial services. And now let me share some concrete numbers that demonstrate the scale of this transformation. For example, in European Union, the PSD2 directive has been a game changer, actually, enabling over 7,000 entities to access bank APIs. This isn't just a European phenomenon because we're seeing similar movements across the globe with countries like Australia, Hong Kong, Singapore, and Mexico actively embracing open banking frameworks. So what I find particularly exciting here about the open banking, I would say that it's how it's democratizing financial services, because when customers can securely share their financial data with authorized service providers, so it opens up possibilities for entirely new types of financial products and new types of financial services as well. Because if you think about how fintech companies can now create more sophisticated budgeting tools, or how lending platforms can make better informed decisions about creditworthiness, for example, it's fascinating. The next slide. Now let me share with you how strategic partnerships are becoming increasingly crucial in today's banking landscape, particularly between traditional banks and fintech companies. So these kind of partnerships are fascinating and very important. And the most fascinating is how they combine the best of both worlds, actually, because traditional banks bring their established trust and regulatory compliance and extensive customer base, while fintech companies contribute their innovative technology and their agile approach to service delivery. So let me share a striking statistic with you. For example, about 75% of the bank executives believe that forming competitive partnerships with the fintechs and big tech companies is crucial for their long-term survival. And this isn't just about staying relevant, but it's about creating a new value propositions for customers. So, and now I'd like to highlight a prime example of such a partnership, because the collaboration between Goldman Sachs and Apple for example, in creating the Apple Card, for example. And this partnership beautifully demonstrates how combining banking expertise with the technological innovation can create groundbreaking financial products even. Because Goldman Sachs brings its banking infrastructure and risk management expertise, while, for example, Apple contributes its user experience excellence and massive customer base as well. And these partnerships are really reshaping the banking landscape, especially allowing both traditional banks and fintech companies to overcome their individual limitations and create more comprehensive and innovative financial solutions for customers. The next slide. Now let me introduce you to an exciting development in banking, the hybrid of phygital banking model. So, and this approach is particularly interesting because it combines the best aspects of both physical and digital banking experiences indeed. Now let me break this down into its main key components. The fact is that the hybrid banking model is all about finding the right balance between human interaction and digital accessibility. It's not about just choosing one over the other, for example, but it's about offering customers the flexibility to engage with their bank, for example, in whatever way suits them best at any given moment of time. So, if you talk about some concrete examples of how this works in practice, so I can tell you the following. For example, if we take Santander and Capital One, so they have reimagined their physical spaces by creating banking cafes. You can imagine. And these aren't your traditional bank branches. So they're relaxed, for example, welcoming environments where customers can get financial advice while enjoying a coffee. And it's a complete reinvention of what a banking space can be. And what is particularly noteworthy is the industry's commitment to this approach. Because for example, some research shows that over 60% of the banks are planning significant investments in the hybrid models. This isn't, I think, this isn't just a temporary trend. It's a fundamental shift of how banks are thinking about customer engagement. And finally, these hybrid models recognize that while digital banking is increasingly important, they are still moments when customers value face-to-face interactions, and especially for more complex financial decisions. Let me summarize the key points we've covered in this lecture about the digital banking models and services now. First, we traced the fascinating evolution of digital banking from Bank 1 all the way through the Bank 5, showing how technology integration has fundamentally transformed banking over time. We then explored the 4 distinct neobank models. You can remember how some leverage their parent company's infrastructure, while others focus on optimizing user experience, utilizing modular systems, for example, or even placing digital capabilities at their core. And each approach has its own unique advantages in serving customers. And we also discussed the 4 neobank archetypes, like traditional, market leaders, challengers, and the followers. And what is particularly interesting here is how each of these followers of this archetype following distinct strategies to compete in the digital banking space. And then we examined the preference based models like client first, mobile first, and AI driven approaches. We saw how these models complemented by banking as a service and open banking partnerships as well. A particularly important trend we discussed is the expansion of the banking ecosystem through the building of financial and non-financial services, because this is really revolutionizing how banks create value for their customers. And finally, we looked at the rising importance of embedded finance and through, for example, BaaS partnerships, and which is opening up new possibilities for both banks and for non-banking entities. And I should say that these developments collectively represent a fundamental transformation in how banking services are delivered and consumed in the digital age. So now we have come up to the following quiz. Please take a couple of minutes to enter the following question. You can fill in your answer to the chat, please. Okay, thank you for your answers. And the right answer is, the right answer is third, which is Model C. You're quite right. Thank you very much. Here you can find issues for discussion. So we do not have enough time for discovering this, but you can take it, for example, as a homework. But nevertheless, if you want, just if you want. Here you can find a glossary. Okay, and do you have any questions?